When we think about global markets, our minds jump to this super complex web of stocks, bonds, and these giant investment firms, right? But what if I told you that behind a huge chunk of all that complexity, there's a single, incredibly powerful company that's, well, setting the rules for the whole game? A company that, honestly, most people have never even heard of. Okay, let's get into it.
Just think about that for a second. If you wanted to buy a tiny piece of the entire global economy, how would you even begin? I mean, which companies do you pick? How do you know you're actually getting a fair slice of the world? It's a massive, almost impossible challenge.
And boom, here's the answer. Whether you realize it or not, if you've got money in a global fund, odds are you're paying a small fee to a company called MSCI. They are the invisible architects of modern global investing.
So, to really get our heads around how they became this powerful, we're going to break this down into 5 key parts. First, the invisible standard. Then we'll look at the index engine, what they actually sell. After that, we'll talk about their unbeatable moat, the scale advantage that comes from it, and we'll wrap up with a really big final question.
All right, let's kick things off with their core position in the market. See, MSCI isn't just another player. They basically write the rulebook that almost everyone else has to play by.
Now, you really got to let this one sink in for a second. This quote right here, it's not just some opinion. It's the cold, hard reality of the market. The key phrase is virtually required. That means if you're a huge fund and you want to offer a world market product to your customers, you don't really have another choice. You have to go through MSCI. They've become the default operating system for global investing.
Okay, so if they're not managing trillions of dollars themselves, what are they actually selling? This gets us to the absolute core of their business model, the index engine.
Think of it this way. MSCI creates the recipes. An index is basically just a list, right? A blueprint that says, hey, if you want to track the world market, you need to own these specific stocks in these exact amounts. So then, massive firms like BlackRock or Vanguard come along and pay MSCI a licensing fee just to use that blueprint to build their funds. MSCI sells the map, they don't actually drive the car.
So this brings up the obvious question. Why doesn't somebody just create a better, cheaper map? Well, the answer lies in what investors call an economic moat.
Just like a moat protects a castle from invaders, a strong economic moat protects a company's profits from its competitors. And let me tell you, MSCI has one of the widest, deepest moats you'll ever find.
Their moat is built on 3 really powerful pillars. You've got network effects, which we'll look at in just a sec. Then there are high switching costs. I mean, once a multi-trillion-dollar fund is built using your index, changing it is a total nightmare. And third, they have super low capital needs. They're just selling data, not building giant factories, so they can grow without spending a ton of money. But it's that first one, the network effect, that creates this incredible, powerful lock-in.
And this slide right here shows exactly how it works. It's this beautiful, self-reinforcing loop. Just follow the flow. A big fund starts tracking an MSCI index. Okay, step 1. Well, because that fund is so massive, that index becomes the benchmark for everybody else in the industry. So now, any new funds have to adopt it just so they can be compared fairly. And with every single new customer, the standard gets more powerful and more locked in. It just feeds on itself.
So, what does a moat like that actually get you? Well, that brings us to their mind-blowing financial advantage. This moat doesn't just protect them. It basically allows them to print money with staggering efficiency.
Just look at this comparison. A typical fund manager has to deal with massive operating costs and all this complexity as they get bigger. But MSCI, they just sell the same digital blueprint to 1 customer or to 10,000 customers. The extra cost to them is practically zero. It's a purely scalable, incredibly high-margin business model.
And the result of that beautiful business model? Get a load of this number. Over $15 trillion. To try and put that into perspective, that is more than the entire annual economic output of China. It's a massive slice of all the world's wealth, and all of it, in some way, is paying a little toll to MSCI.
Okay, so at this point, you're probably thinking, wow, this sounds like a perfect business. And you'd be right. So what's the catch? There's got to be a downside, right?
Well, the catch is pretty simple. The market isn't dumb. Everybody knows how fantastic this business is, and that quality is absolutely reflected in its stock price. A business this good is rarely, if ever, on sale.
And you can see this perfectly reflected in the data. Think of free cash flow yield as basically how much cash the business spits out for you compared to its price. It's kind of like the interest rate on your investment.
And as this chart shows, that interest rate you get is currently near a 5-year low. All that means is the price you have to pay for this incredible cash machine is near a 5-year high. The market has priced this perfection in.
And all of that brings us to our final thought for today. What does it actually mean when the company that makes the map becomes this powerful? MSCI's decisions, which stocks get included in an index, which get kicked out, can literally move billions of dollars overnight. That affects real companies, real jobs, real economies, and it leaves us with this really fascinating and kind of profound question to think about. In a world that's dominated by passive, index-based investing, what happens when the map itself, the index, becomes more important than the actual territory it's supposed to represent?